Hi, this is Nana Fik, and I want to talk to you about pattern recognition in this session. When we're using technical analysis and when we're using price action and we're looking at patterns, it is from a belief that the market is repeating itself again and again and again. And therefore, if the market has a tendency to move in a certain way under certain conditions, then we assume that the next time the market will act this way, then probably it will do the same as it did the last time and the last time and the last time. And it gives us information about whether we should be buyers or we should be sellers. That is what it is all about, figuring out, should we buy or should we sell this market? Is the probability that the market will go up, or is the highest probability that the market will go down? And if we're looking at this chart I have here, this is gold and this is a 4-hour graph. And if we're looking at this chart, how do we know whether we should be buying or we should be selling? We don't. And because we don't know what to do, then it is a little bit like standing on 10 meters above the water, not knowing whether there is water or not below you, and then jump. We don't really want to do that unless we know if there is water below us. But when we are trading and we are investing, we don't know if we're going up and down. So it's the same as not knowing whether there is water 10 meters below us or not. And if we are not right, and we, for example, sell at this point, and the market then turns around and goes up, then we will be losing money. And the feeling is a little bit the same as if we jump and there is no water, we will be done. So it is that kind of fear we are working with on a daily basis as traders. So we need to use some different tools that can give us some degree of certainty that the market will go in the direction we anticipate it to. And when we're using pattern recognition, we are looking at what are the buyers and the sellers doing. This is always a balance point between buyers and sellers. And we want to be in the direction as the point of the market, the balance point of the market where the most participants are. So if the market is going down, we want to be selling. If the market is going up, we want to be buying, because when it's going down, the majority of the market is at the selling side, the short side. And if the market is going up, the majority of the market participants are on the upside and long side on the buying side. So this is what do we get from this? Nothing, actually. So we need to start using some knowledge we can build. And first of all, we can see here that we have a line up here, and we have a line down here. This is a trading range. And when we have a trading range, we can see that when the market is going up here in this area, then the buyers are disappearing from the market. There are no more buyers because the market is not going higher. Actually, the market starts going down, which means that up here, there are many more sellers than there are buyers. And then we can see when we get down here, there is like a floor down here, and the market cannot go further down. This tells us that when we get down here, the sellers disappears from the market, or there are much more buyers in this area down here than there are sellers, and therefore the market starts to go up. When we know this and we can see this, we can build a rule. And the rule is that when you see a trading range, until something else is happening, at the top of the range, you should be selling, and at the bottom of the range you should be buying. Simply because you can see that the majority of the buyers are disappearing up here, the majority of the sellers are disappearing down here, and you want to be in the direction where the majority of the market participants are. So this is a rule, this is a pattern, and pattern gives us rule to use when we are trading. And patterns is all about understanding what the majority of the market participants are doing. So this is the range. If we go a little bit further into this analysis, then we can actually see that we have a top level up here, but when we get over here, the level actually moves down to here, which means that in this gap here, after this point, the buyers disappears earlier from this market. And what we can see is that we have a bottom here, we have a lower bottom here, and right now we have a lower bottom as well. This tells us, if we change these lines a little bit, this tells us that the balance point is moving downwards right now. So right now, I would rather like to be a seller selling at the top than I would like to be a buyer buying at the bottom, because I can see that the sellers, they manage to push the market lower and the buyers, they disappear earlier and earlier on. So right now, there is a tendency to this market going down. This is a pattern. If we look up here, then it is the same logic we're using. We can see we have a bottom area here. And then we can see that the buyers, they get out of the market earlier and earlier. So this market is up here telling us that there is a tendency to the market being pushed down. There's no guarantee here. You cannot use this as a guarantee and say, okay, this market is going down, so we want to sell because for sure it will go down. There is no guarantee. There is no for sure when you are trading the financial markets. But it turned out that the market actually did go down. And in the price action video, I am talking about how I am looking for a push out of a direction. When the market starts a new move, starts to move in a new direction. And it is the same I do here when I use the patterns, because it is in this area when the market shows us it is going down. It is in this area we want to get into this market and sell here. Then we have, because many people have been studying this for many years, and if we look back at charts that are 100, 200, 300 years old, it is actually the same patterns that will show in these charts than we see now. And it is not because that people were sitting and having charts 300 years ago. No, it is because these movements in the markets, they are created by all the market participants. And the market participants are humans, or nowadays it is computer created by humans. So it is the human way of thinking. And the human brain can only manage a situation for a limited period of time. That is why we don't see markets just going up and never looking back, because we need to adjust to a situation. The human mind needs to adjust to a new situation. And furthermore, we have this thing that I told you at the beginning, that trading the financial markets is a bit like standing and having to make a jump 10 meters down and hoping for water below us that will save us. It is the same. And it is this fear we're working with on a daily basis as traders and investors that is creating these patterns, because then we will be in positions for a period of time, and then we will go out of the positions again. That is just the way the human brain is working. So there is no hocus pocus in this at all. But then we know when we have this triangle pattern as we have here, and it is at the top, then most likely, not always, but most likely, the market will move down to this area. We take the distance from the top to the bottom, where the first top is made and the first bottom is made, the distance, put it underneath this triangle, and then we would have a target down here. Boom. And then we would take profit down here. So recognizing patterns is all about creating rules for ourselves so that we do not have to make too many decisions, take too many decisions when we are trading, because when we are in a trade, it becomes very difficult for us to keep objective and to stay objective. So we need to have some rules. So we look at the chart and say, okay, my rule tells me that we have moved out of this triangle in a downward direction. I can see that this is the distance from top to the bottom in this triangle. Therefore, my target should be down here and I should sell up here. That is the rules, and they're working very often. Sometimes they don't work, but very often they work. And if you just stick to your rules and stick to your strategies, I will talk about strategies in a lection later on. If you do that every time, then you will be becoming a good trader sooner or later. But if you do not stick to the rules and you start changing the way you trade and do other things, then you will have problems, because then you will not get the profit out of the market that the market is actually offering. So this is a triangle. And let's try to see, because over here, we have a quite famous pattern as well. And this is a top. We have a top here and we have a top here. Actually, we do have two tops here, there, and there. We have two tops here, and this is a double top. And why do we look at a double top? Well, it's the same as in every other situation. We're looking at where are the buyers and where are the sellers, and when do the buyers and sellers stop buying or selling, and when do the other part, if it is buyers we're looking at right now, the market is moving up, then we want to see when are the buyers leaving the market. And we have a top here, so the buyers, they managed to push the chart all the way up here, and then it went down. Then the buyers, they managed to push the market up here. It's actually lower than here. And then they cannot get it any further. Then they try once again, and they manage to push the chart up here, the price up here, and then the sellers are taking over. And when we have this double top, now we have 3 times the buyers has been trying to push the market. And this is a double top. And then we can see that the sellers, they are pushing the market down. They are much stronger right now than the buyers. So at this point, when we are down, we're up here, we're down, we have a bottom here, we're up once again, and then we push further down from this bottom, then we will sell this market. Like we did over here, we will make a harmonic move. So we take the distance from the top here to where we sell, and then we put it below and we say, down here, I want to have my target because I expect the market to go down here. This is a rule, a very simple rule, very, very difficult to follow, but a very simple rule. And then one of my favorite patterns is over here. We have a top up here, and then the market has strong momentum down. We get to this area and then we push, okay, up, not too far, not too little, but okay, up. And then we push down once again. We are pushed up quite strongly and a big move up now. There is not a strong momentum to the downside right now, but the market is going down once again. And you can actually see that we have down here a trend line where the market goes down to up, and down. And what we want to notice in this move is that, I will remove the drawings, is that, as you can see, the market is being pushed quite high up, quite aggressively up. It tells us that there is a lot of buy orders here, or a lot of buyers here. Maybe not the first time, but the second time you can see that the buyers managed to get the price up to the level where this leg down actually started. And the third time we push strongly to the downside, but right away the buyers get in, and at the same pace and the same aggressivity, they manage to push the market up. This is a wedge bottom. And what I want to notice in this area is that you can see that there is a high balance between buyers and sellers. And from a move to the downside where the buyers are getting in this aggressively, there is a very, very high probability that the market will turn around and start moving up. So I want to look at these 3 pushes down. 3 pushes, you need to be aware of it, because it is very, very often we have 3 pushes in the market down to here. And when we get momentum to the upside, I would be buying. And then I want to see, because I would expect that we would go up near the level up here, but I don't have the same kind of rule as I did over here where I have this harmonic pattern. I don't. But the 3 pushes, keep an eye on it, because it tells you at a very early stage that the balance between the buyers and sellers is changing. So this is patterns, and there are many, many patterns out there. What is important when you're trading with the patterns, don't take it too, you cannot be too rigid in your mindset when it comes to the patterns and think, okay, I have this pattern now, this will happen for sure, because that is not the way it is. You need to look at the context at the same time. You need to look at the momentum in the market, like I explained to you in price action. So the way I work is price action is the top thing I use. And then for my analysis in price action, I use patterns to figure out what the balance is like in the markets, and where the buyers are and where the sellers are. So you have to train your eyes to see all of these patterns, because I will remove everything now. This is a blank pattern. And if you're not trained to see what is in here, it will be very, very difficult for you to realize where the patterns are. So what you have to do is you need to learn to see all of the tops. Okay, I take the drawing here. You need to see top, bottom, top, bottom, top, bottom, top, bottom, top, bottom. You need to be able to see these moves the market is making in order to see where the patterns are. But after a while, you don't need to make all of these drawings anymore. You will just be able to see the patterns in the market. But train this, and I assure you, you will be very happy for the work you have done in a couple of years. I wish you all the best, and I hope this has inspired you. I will make some more videos, and hopefully it will help you to become a better trader. Good luck out there.